presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compact Market Wrap YouTube update for February the 10th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. Reminder, click on the subscribe button so whenever I post a YouTube update, you'll be notified and you can watch it at your own convenience. Looking at the numbers last week, really nothing. We had a lot of stuff that happened. We had the unemployment data, we had the Fed meeting, we had the tariffs, all of that. Market started out the week sharply lower, then came back up, and at 0.23 lower for the S&P. Not much, slightly lower. We saw the Dow down 0.54, NASDAQ down 0.53. Big mover was emerging markets. They were up 1.4%. Is this something that's beginning? I don't know. We'll have to wait and see. Looking at the best sector, consumer staples, real estate came back because interest rates came down last week. Consumer discretionary was the worst sector. So I think we're seeing a broadening of the market. If you look at the yearly data, the best sector has been financials. The worst sector for the year is technology. So far we're seeing a broadening of the market. Technology is going sideways to slightly lower. I think they're digesting the huge gains that the market technology made in 23 and 24. Still some questions about DeepSeek, what's going to happen with the spending on chips and data centers and so on. But all the large Google, Microsoft, Apple, not Apple as much, but all the Amazon came out and said they'll continue to spend. And they are going to spend even more on AI and data centers. So I think what they're trying to do, and we talked about this quite a bit on the podcast today, Javed and I did, so tune into that, and you'll see the way I'm looking at it right now. Oil slightly lower last week, nothing very dramatic, but the big move to the downside was interest rates. They came down from 4.58 to 4.49, 10 basis points down for the 10-year. The new Treasury Secretary said we'll be watching the 10-year, which is something new, rather than watching the Fed fund rate, which the Fed sets up. They talked about the 10-year, so they want to bring long-term rates down. And I think if the market starts to weaken a little bit, they will step in and they'll start cutting rates. I think that's what we're going to see. We're hearing a lot about DOGE and cutting government jobs and so on, but I was surprised. We put this chart out on the weekly newsletter, but you can see that government employees, federal employees are only 1.9% of the total government payroll out of the 14.9%. Most of it is state. That's where all the jobs are and all the government employees are. They're state employees. They're not federal employees. So even though we're cutting out USAID and a whole bunch of departments, which is, some waste we need to get rid of, there's just too much waste. But I think we have to look at the state and local and state governments and see if there's waste. But local governments, we need a lot more firefighters. We need a lot more police. We need a lot more of the services. But there's other areas, I'm sure, that the state and local governments can cut out. So that's where the cuts need to be. Job openings were down. That's something that we're starting to see. Unemployment numbers came out. Jobs created, they were expected to be around 175,000, 143,000 jobs created last month. So that was lower than expected. The market is coming back in balance. It's not that unemployment is going up dramatically. Wages were up nicely. Unemployment still steady, 4.1. So it's not going up. But the amount of jobs available has come down a lot. And we're starting to see the new jobs being created has slowed down. And that is just showing that after the COVID surge that we saw in job creation and people being hired because everybody had been laid off. This week, the big numbers are going to be CPI. We've got to watch. It's expected to be around 2.3 or 0.3. That's what we're expecting. Then the next day we get the PPI. That's the producer price index, also expected to be 0.3. So not a big change, but we are going to see the previous number in CPI was 0.4. We go down to 0.3, that'll be good. This was 0.2. If it goes up a little, it's okay. I think as long as we are here, but if inflation comes down, and we have to watch the shelter component in it and auto insurance. Those are the two biggest contributors to inflation, or the CPI. If those come down, they would be big. Then we get retail sales. they're expected to be down a little, so a little softer than the 0.4 that we got last month. So we get this number, that means, again, the consumer after Christmas is a little tired and they want to take a little rest. That's okay, but we have to watch this retail sales because 2/3 of the year's economy is consumption. Looking at the technicals, we're just bouncing along in this range, about 6,100 to about 5,800, just going back and forth, back and forth. Nothing very exciting here. 6028 is the 20-day moving average. 6,000 is the 50-day moving average. We're 6070. But looking at the weekly chart, we came and tested this. You can see this red line that I've talked about since October of 2023. That was the low in 23. We've come and tested this quite a few times. We got below it this week right here, came back up, closed above it. Tested it for 2 weeks in a row. Came back down, tested it here in December, came back up. Last week we came and tested it again. So 5950 is the number I'm watching. 5944 is the 20-week moving average. Today we're 6070. Last I looked at the market. So we're still okay. But if we break below here, then we come down to about here, 6,700. And that could be, we're looking from 6,100, about 400 or 500 points down as a fourth wave correction once that starts. And then we go up for the fifth wave for the rest of the year. But this usually can take a few weeks. Daily, well, again, we're looking at here, NASDAQ, again, sideways, not going anywhere, just back and forth, up and down. As long as we're here, the weekly numbers, I'm looking at this dot plot right here, these dots. When the market gets below them, you can see it goes down. The market gets below these dots, you can see we go down. We're above these dots. The market is here, and the dots are here. But that dot is around 18,200, 18,200. And that's what I call my dot plot. If it comes down here, breaks below 19,100, we're at 19,700. So that's still a long ways. 18.2 is about 1,500 points I'm looking at right there. So I think we're okay. Market's going sideways, digesting the gains. Nothing very dramatic. 10-year yield went up to that 4.8, fell all the way down. We're bouncing up a little bit today. 4.49 is the number. We're at 4.49 today. A little bounce here. Then we come down. And as long as we're in this range, 4.5, somewhere around here to here, we're okay in this range going back and forth. Market can handle that. Small caps right at resistance, 20-week moving average, 227. We are at 227 today. So again, I like to see it break out above it, break out above here, but we've gone through this for what, 2-3 years now. This was the low in 21, high 20 in 21. 2021 was this high right here, and we came and tested it right here in 2024. It's been 3 years. We haven't gone anywhere, just up and down, back and forth, up and down, up and down. We need to break out above 245 to confirm the show, and that will only happen if interest rates come down. Crude oil, nothing very exciting in a downward trend. Big update today. We're up about $1.50 a barrel today. Gold is something that I'm watching, and it's really taken off to the upside. We're at 29.33 today. I think what we're starting to see, people around the world, especially central banks, are getting nervous about the dollar. They're saying the U.S. is using trade now as much more of a weapon, and we're talking about tariffs, we're talking about all of these things, and that's what we're looking at right now. So we're looking at all of these things, and we are going to see what happens. I think what the banks are doing is they're buying a lot more gold, and that's what they're doing. Just as a safety measure. And they're starting to hold gold, the central banks are, so we'll see. Looking at this, again, don't forget to subscribe to this channel. If you need help with your portfolio, go to invest@compact.com or give us a call at 1-800-388-9700, and we'll be more than happy to help. Those are my views. Those are my thoughts. Next week is President's Day, so I will not be back on Monday, but I'll be back on Tuesday. Have a wonderful long weekend. I'll see you then. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.